This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 73. What makes a currency stable?
Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie, and today, what makes a currency stable? The pound has lost ground since the Brexit vote, but seemed to gain a little of that back, then lost some of it again. The US dollar rose on the hopes of a Trump presidency that might see some opportunities for economic growth, but it seems to be losing those gains as people realise that's probably not going to happen. Then there's currencies like the Aussie and Canadian dollars, driven largely, it seems, by fluctuation in the price of commodities. So how do you make a currency stable? Is it a fruitless task, or is it something central banks could be doing more about? That's today on the Debunking Economics podcast. So this actually is a question from a listener, Steve. David asks, what makes for a stable currency? I've heard some argue that it's low public debt to GDP level, and others argue that it's low private debt to the GDP level, or are both important? Do you think that debt levels are the critical variables? If not, what variables should be considered? I think I know what your answer is going to be. Can I have a guess what you're going to say before you say
Yeah, sure.
it?
Yep.
I think you're going to say balance of trade is probably more important.
Yeah, there you are. You're dead right. It's the vital one, and this is one of the areas where economic theory is incredibly weak and has been a very misleading about the dangers of a trade balance being extreme, because and it's not just neoclassical theory. I think it's also partially what's come out of the modern monetary theory crowd. I'm going to annoy some people saying it, but I'm getting used to annoying people, so why don't I do it?
You do it.
But a trade balance, the neoclassical vision, which goes back to the idea of comparative advantage and the arguments which Milton Friedman, amongst many others, are making for floating exchange rates, abolishing the Bretton Woods Agreement, going for floating exchange rates, is that with a floating exchange rate, the price level of the exchange rate will do all the accounting for you. So if you have in a country which is running a trade deficit, then it's going to have its currency falling in value. Because its currency falls in value, therefore, its imports will be more expensive, its exports will be cheaper, it'll return to equilibrium, and a world of floating exchange rates will lead to balanced trade around the world. Now, empirically, of course, we've had 40-something years now of floating exchange rates, and we have enormous trade imbalances. And partially the explanation that people give about why that's happened comes back to saying, well, there's so many governments involved in dirty floats. You know, it's not actually really a free floating exchange. Countries do engage in trying to second guess the market, keep their currency at a set value at one extreme, and then of course you've got the biggest elephant in the room is the European Union, because what that's done is locked together the whole of Europe into a pseudo country, which is not really a country at all. But that means that parts of it, like Germany, have a massively undervalued exchange rate and are running trade surpluses of the order of 10% of GDP. That applies to pretty close to Germany, Denmark, Switzerland, I think Norway's similar levels. So, of course, if they're running 10% of GDP deficits, then precisely the same aggregate quantity has to be run as surpluses.
Yeah.
They've been matching deficits elsewhere, and that's why you haven't got balance. And that is not right. That is not the full explanation.
And look, and the reason why I knew that was going to be the case was because I look at the way currency traders work, and they keep on turning to the Japanese yen as the safe haven currency. And, you know, there you've got a country where the public debt to GDP ratio is very high. I think it's about 200.
And the private, yeah.
Yeah, both very high, absolutely. And yet it's a safe haven. And what's the reason behind that is because they are selling so much more. Their current account surplus is so huge. And of course, it's the same with the Swiss franc as well, which is the other one people turn to. And in fact, the Swiss franc was tied to the euro, of course, until a couple of years ago. When it was unpegged, there was a massive impact on the euro. And then you look at what's happened to the Swiss franc since, after that brief shock, and it's been trading very steadily in a tight range, because here's a country that has got got its own currency, and it's got a high current account surplus.
Yeah, and so the fact that the Swiss currency is now we're free floating, having been freed from because it was the euro went down a bit, but the Swiss franc went up dramatically.
Yeah.
Do you know what's happened to this? Has it actually come down since then, or
it's gone back below where it was? But I mean, the main, in a way, that's irrespective, isn't it? We're talking about stability. It's a very stable currency now.
Yeah, and that's again because the trouble again about so much of economic thinking, neoclassical economic thinking in particular, it's static. They draw supply and demand curves, point of intersection, end of question. They're not putting it in a dynamics in whether you've got growth and change over time. So, for example, to come back to one of my favorite issue, it's not my favorite, one of my favorite issues is should the government run a surplus or not? The argument is no, it shouldn't. It should run a deficit because by running a deficit, it creates part of the money supply. Now, if you have a static perspective, you can think, well, the government should, in general, have a balance. So, like over the long term, should be zero aggregate government balance. Well, if that's in a static world, that makes sense because if you have a zero balance over the long term, then over the long term, government money is a set proportion of a fixed money supply. But if you've got a growing economy, say that the government should have a zero balance, then over time, the government contribution of money goes to zero because the rest of the economy grows and the government does not. And the same thing applies with trade. When you look at trade, people think, oh, well, if we have floating prices, then bang, everything will be reached an equilibrium. No, if you have a country running a trade surplus, then it's getting investment funds from the rest of the world by running that trade surplus. It can then pour those funds into investment, innovate, and continue remaining ahead of the rest of the world, therefore maintaining that trade surplus, even though its currency is appreciating. The price change will not compensate for the productivity differences over time. And you can have a country like Japan, which has been running a trade surplus now for going on 40, maybe even 50 years, even through all its ups and downs caused by its financial system.
And, of course, it's so reliant on oil imports as well. So the price of oil obviously does have some sort of impact. I mean, their currency is stable because, as you say, it's been going on for so long. We assume that they are always going to be in surplus. Therefore, we can always assume that there's going to be a demand for their currency.
Yeah, and then that gives you a stable currency base, even when they try to drive the currency down. I mean, they had succeeded in reducing it, but people, I think the original value of the yen to the dollar was 350 yen to the dollar. And there's something in the Japanese political system involving the number 350. It got down to about 100 or even 70 at one stage. It's risen back since then. But for that whole period, it was appreciating, and for that most of the time running a trade surplus. But the increase in the price was never sufficient to stop them running that trade surplus. They were still innovating. And this is the reason if you have a trade surplus, you have a strong manufacturing sector, and manufacturing is where you can innovate. And over time, as I argue in my energy arguments, what you're fundamentally doing is finding a way to harness energy more effectively than other people do and bundling that into products which provide a larger energy surplus to the purchaser. And that technological lead can be maintained for decades, so long as you run that trade surplus.
The size of the country obviously has a lot to do with it as well, because, I mean, China's got a high trade surplus, so does Russia, so does South Korea. The Russian ruble, though, I mean, you know, we've seen it fall by more than half over the last 4 years. But you know, perhaps it's the trade balance per capita that counts.
It's also the trade balance with manufacturing,
right?
Because the Russians, fundamentally, it's an oil economy. It's a resource-based economy, oil and gas, and therefore you're completely susceptible to the ups and downs of the oil and gas price, and that goes ups and down with economic booms. So you've got
to make stuff.
Yeah, I mean, you've got to make stuff. Yeah, and the Japanese got almost no resources, but they're running a trade surplus. They're paying for stuff with the incredibly volatile prices that commodities have, and still producing goods even after they've been stuck in a slump for 25 years after their bubble economy burst. They've still got that technological advantage, that manufacturing advantage that England clearly has lost. And what you then have is the fragility of the currency comes from the fact that it simply can't manufacture enough goods to build that trade surplus. And I actually mentioned economic theory earlier, and we didn't actually elaborate on this point, but economic theory teaches you that a country running a mercantilist trade policy will fail because it will cause inflation. And the inflation will undermine the value of the currency. And, of course, we can see tremendous empirical proof of that proposition in Japan and Switzerland and Germany and, of course, total bullshit.
Yeah.
They have not suffered from domestic inflation. And this is the reason people didn't worry about trade surplus. They thought they'll they come up, and no, they haven't. Mercantilism has been an extremely successful policy, and what we need to have is an international regime that stops that, and a floating exchange rate system has not done it.
So, hence the need for a separate central currency to the US one, which we've talked about in the past. What about interest rates? I mean, central banks would like to believe, they're tinkering at the edges, is having a profound impact on the stability of a currency. The higher the interest rate, obviously, the more attractive the currency is, because you're going to get a higher yield on bonds that you buy in that currency. But if we look, interest rates are going nowhere in Japan, yet the currency is very stable. So what about the role of interest rates and the stability of a currency?
Again, that can have an impact, particularly in a country like Australia, which is running a trade deficit. Pardon me. You've got interest rates. If interest rate differential of the rest of the world is extremely high, and you are running a trade deficit, then partially what you finance that trade deficit with is a capital account surplus. And for that capital account surplus, you've got to be selling bonds or selling assets. And in that world, your interest rate becomes a major indicator of whether there's gain or loss for somebody in diving into that currency. And in the Australian case in particular, because Australian interest rates were so much higher than the rest of the OECD after the crisis, because the government managed to recreate a bubble and avoid the crisis back in 2008. And actually, the Australian government the central bank was putting up interest rates after 2010 in the belief the crisis was over. That gave you, in case we compare it to Japan, as much as a 4%, think about a 3%, 4% differential between bond rates in Japan and bond rates in Australia. And what that meant was, I think it's called the Mrs. Watanabe effect. Is that the name?
Okay. If it's not, it is now, because you keep on using it.
Thank you. Okay. I said, hey, fake news. Wonderful.
You heard it here first, because we made it up.
I've got to check and see if I'll look it up after our conversation. But what that meant was it was possible for private investors, private individuals in Japan to buy Australian bonds and get a double whammy, because as well as getting like a 4%, let's say 4% is a reasonable number, is a 4% gain over the rates they were getting in Japan, because they were buying the bonds in such volume, they were driving up the Australian dollar as well. So as well as getting a high return, they were getting a capital appreciation. And that can give you a massively overvalued exchange rate in the Australian case compared to what it would be if the interest rates were the same as the rest of the world. And that's seen in the Australian case as a major reason why there is no longer even a foreign-owned car industry in the country. It's all been shut down, because there's no way you can compete with local exchange rate being as high as it is, and wages being what they are in Australia, and the production runs being as small as they are. You can't compete with imported in cars. So there's no car industry anymore, and many other manufacturing industries have shut down for the same reason. So the interest rate differential can be seen as contributing to that substantially.
So, I mean, is it as simple as central banks saying that, look, we're not making enough in our economy, but we need this foreign currency, so we need to play with interest rates to try and get that money in? Is it negating the effects of not having a trade surplus? Is that basically what's happening? And if you have got a trade surplus, you need to worry less about that, which is why Japan, not particularly concerned that their interest rate is basically zero. Yeah,
and then that's in the Australian case. Part of it was because they saw a return to economic normality, which hasn't happened. So that's one reason they put the rates back up. But they also did see it in terms of we've got to balance the trade deficit with a capital account earnings, and therefore you've got to offer the returns to get the capital account earnings. And the vision was, and this turns up in a lot of neoclassical theory as well, a country running a capital account deficit. So I mean, this is where the terms get to be the inverse of the terms you'd use in the privates, looking at private sector surplus versus deficits. But if you're running a trade deficit, that means you've got to you've got to be selling your assets on the international market, so there's a surplus on that side. And in doing it, the vision was, well, you're doing it because you're investing. The reason you're running a trade deficit now is you're importing all this capital equipment that's going to mean you can produce this huge increase in productivity in the future, and therefore it will balance out, and you go from a deficit to above, and in the long run, the averages are equilibrium. We've been 40 or 50 years, in Australia's case, of running a trade deficit, and we've been deindustrialised in the process and have less capacity to get back to balance again than countries which did the opposite.
And a less stable currency as a result. I mean, when there's any risk sentiment in the world, people sell the Australian dollar.
Yeah, I mean, it's been described to me by traders as it's the slot machine of the global financial system. When you're walking out the door from the casino, you've made a bit of money or lost a bit of money on blackjack. You throw a couple of which blackjack being the euro or the yen or the American dollar. You'll whack a few coins in the slot machine to hopefully recoup your losses if you're lucky on the casino currency of the Australian dollar.
So, but the Australian economy also has high debt. So does that have any influence? I mean, we've talked about trade deficits being the overriding factor. Does debt have any part to play in the stability of a currency?
I think it does, and again, it's predominantly private debt that I'm thinking about in that case, not public debt for the countries that issue their own currency. But one thing which comes out of the research in my mathematical modelling is that a higher debt level is associated with a lower rate of economic growth, in the sense that if I set my model up to have a lower level of investment desired by capitalists, which you would think would lead to a low rate of growth, what it leads to is a lower private debt level. And in fact, a higher rate of growth, because more of the money is still going to the capitalists for investment rather than to the bankers for debt service. But if you have a runaway where the capital have a higher level desirable level to invest, that means they end up borrowing more money. You get a higher debt level, and you actually get a lower rate of economic growth. And that's at a very generic level. I haven't got any division of industry. All I've got is manufacturing fundamentally in that very simple model. But I don't think that insight is genuine, what we've seen. So the high debt level means you have a lower rate of growth.
Yeah. Okay, makes sense. And of course, if you have a crash, like it could happen in Australia, then that really will impact the stability of the currency.
Yeah. What you'll see is with the country does have it's going to have a housing bubble has to come to an end unless Chinese buying keeps it going for indefinite period. But I can see that the one card they've got left is Chinese buying of property to keep the bubble going. And once the bubble stops, the credit growth stops, and then the economy will have a slump. And in that slump, what you're likely to see is a massive fall in the value of the Australian dollar.
So look, it may continue, but every Australian will have to left the country because they can't afford to buy a house there anymore. And you're already seeing that, actually. I know so many people who've left Australia, myself included, because you can't afford to buy a house there. So that is the repercussion of it all. Looking at the currencies again, the stability of it, there's also a bit of tradition in amongst it all as well, isn't there? I mean, we've got hard currencies like the pound, rightly or wrongly, the euro and the US dollar. They're seen as being stable, so they're traded more because of it, and because they're traded more, they become more stable.
Yeah, and this is the other thing which we haven't talked about so far. The volume of trading that occurs is orders of magnitude higher than the volume of trading that's done to actually finance goods and services exports. So, I mean, again, the comparative figures are something like the volume of trade on currency markets every day is sort of equivalent to like half a year's GDP. So you get the volume of trading can be a couple of hundred times the actual level of output of the economy, let alone the volume of exports and imports. So fundamentally what's setting that prices is not something based on fundamentals. It's the speculative waves. And again, according to neoclassical theory, the speculators should wipe out those who are bandwagon followers and leave only the ones who are based on fundamentals. That's another pipe dream. So the volume of currency trading is phenomenal. And of course, it's got all these things like contract for difference, which should make it even more levered and so on. So the valuation ends up being the product of what Keynes once described, the byproduct of the actions of a casino.
But it's interesting, isn't it, that the speculators are following your logic. They're not following the logic of saying, well, the most stable currencies or the currencies that we want are the ones where debt is low. They're saying, no, the currencies we want are particularly when there's a risk mood. The currencies we want are the ones that have got a strong positive balance of trade.
They also have the American dollar as the refuge currency. This is the other thing which happens. So even if there's a crisis in America, when there's a global crisis, there's a desire to buy American dollars because they are the international currency. And this is where, again, I separate from the modern monetary theory crowd on this particular point, I think, and that is I would like to see the bank or instituted and go back to a form of semi-fixed exchange rates where there's pressure on surplus nations as well as pressure on deficit nations. So at the moment, you can literally run out of American dollars unless your currency depreciates. Appreciates. You can run to those dollars. So but the Americans can't run out of American dollars. So consequently, there's a deflationary pressure coming out of all that. That means the surplus countries should be spending to buy more imports to balance it, but they don't. They accumulate that, and they then change their own domestic investment financing and so on, as Germany has done, and benefit from it. And you therefore have a deflationary tendency in the global economy. Whereas if there was a pressure on the surplus nations to spend, which is part of Keynes's Bancorp proposal, you would not have this deflationary tendency in the global economy as a whole. So we have all sorts of problems in the financial system, and the whole idea that making it market-based alone would be enough has been a complete failure.
All right. The advantages, finally, then, to a stable currency, to the people in the country. I mean, it might be nice if you're running a business in that country, you've got a very stable currency. It might be easy for you to forecast, although not necessarily, of course, because you're dealing with countries that might have a currency which is less stable. But even so, I mean, a stable, I guess related to that, I've just given it. The reason why a stable currency doesn't necessarily mean the same as a stable purchasing power, because you're in a global economy.
Yeah, but generally speaking, the less volatility your currency have, the more you're going to get that overall stability, and you can actually do long-term contracts. And if you're trading, again, the Americans have got this advantage that they're not particularly aware of it, but if you are denominating contracts in the American dollar, you can always pay them at $1 for an American dollar. So that gives you capacity for long supply chains that are more difficult for countries with a volatile exchange rate, where they could lock themselves into a long-term contract, for example, for the purchase of oil, and then find it doubles or trebles in their currency terms because of a change in the value of their currency, and they get wiped out and go bankrupt. So that's again an advantage for the stability of your currency overall. You don't face that price adjustment potential to be wiped out in long-term contracts.
Well, there's the answer to the question then that David asks. What makes a stable currency? The answer is the stable currency is largely determined by having a positive balance of trade.
Yep.
I got it right at the beginning. Are you proud of me?
I am indeed, mate.
We'll catch you again soon.
Okay, mate.
Next time, something that Steve and I disagree on. Brexit. He thinks it's a good thing. I think it's a cliff edge for Britain. And in particular, the Irish question, for which I think there is no answer. We'll look at that in a bit more detail. That's next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening.